I'll announce it in the Discord. I will put it in the chat here. It's just exclamation futures if you ever forget where it's at. But we've formed an official partnership here with Ninjatrader, and this is a futures platform. Some important questions have arisen based on the fact that this does not is not affected by the $25,000 minimum margin account for the pattern day trading rules. And the reason for this is it's futures accounts and not, quote unquote, spot, right? So if you are using micros, the margin requirement is $50. That's it. Okay. From there, it's really up to you how big you want to make the account. But there's a couple things I really want to cover. And first of all is if you are not successful at trading, changing platforms, changing tickers, changing your input method of your trade is not going to change any of that, right? So please continue to dial in your edge. This is not changing your edge at all. It's just giving us access to a lot of the things we've been looking for in another format, right? So at the end of the day here, futures are simply that. They are the futures tickers that you can pull on TradingView. Now, the other big thing is any of those tickers you pull right now on TradingView are delayed, right? It is not like crypto where the data is free. It's pushed everywhere through APIs. You can follow it to the exact, tick. Every exchange has their own charts, and that data is all free as well. This is very, very, very different, right? So to trade futures properly, you need to have the data plugged in. Now, if you do create an account here on NinjaTrader, it costs absolutely nothing to set up. It's free, right? If you fund the account with a maximum of $100, you get free TradingView integration, which means it'll push the data to TradingView so you can see the live correct charts. It will push the order flow to TradingView so you can see the correct order flow, and it'll give you the actual integration of TradingView itself for free. Now, if you don't fund the account and you're just messing around with it, that TradingView integration is $9.99 a month. The data itself is another $49 a month, and then the order flow is another $50 a month as well. So you're getting a ton of free things with a funded account. And when I say funded, this is your money. This is not a prop firm or any of that nonsense. I shouldn't say nonsense. It's not a prop firm, right? You're not trading to qualify for anything. It's just like hopping on BidFi or MEXC or Kraken or Webull or E-Trade and using your own money to trade, right? Now, some things I'm excited about is we get futures access to things like the ES, the NQ, the Russell, the NAS 100. We get things like soy futures, oil futures, gold futures, all the commodities we could possibly need. There's like 60 different tickers we can trade. Now, if you like the platform itself, you like the trading platform itself, instead of integrating it into TradingView, you can plug anything into it. You can plug your Webull into it and get to your stocks and still use the order flow data without being charged extra for it. You can plug in your E-Trade, you can plug in your Coinbase, you can plug anything you want into it. I'm gonna slowly through New York sessions start showing people how to use the the NinjaTrader software. It's got one very big key feature that I like over TradingView, and I'm trying to figure out if I want to keep using it that way or try in a different fashion, but it's the entry tool, right? So you can define, unlike TradingView, unlike MEXC, unlike anything I've used before, you can pull a tool on your screen to have set amount of risk for every single trade, and it'll as soon as you hit execute, it'll automatically place everything for you based on a drawing tool, right? You click, you drag, you set, you go. It's all predetermined. It enters it all automatically. It enters the stops. It enters TP1, 2, and 3 if you want it that way, or TP1. It defines everything with a very simple and fast click entry model. It's very, very nice. And there's some other things that even improve upon that we can cover as well if you want to pick something up for $10 or something like that. At the end of the day, I think it's a great opportunity for the people who are looking to kind of move away from crypto a little bit, move away from Bitcoin a little bit, and explore some of these other options. It also opens up a ton of high liquidity options to trade, like grain futures, livestock futures, dairy futures, lumber futures, fertilizer futures are all options to trade on this, right? You have the index futures, which are going to be the mini S&P, the mini NASDAQ, the mini Russell, the mini Dow 30, things of that nature. You're going to have energy contracts. You're going to have crude oil, natural gas, heating oil, gasoline futures. You're going to have treasury contracts. You can actually trade bond notes. So the 10-year note, the 5-year note, the 30-year note, and the 2-year note are all going to be accessible. And if you like the platform, you can still trade Bitcoin and Ether futures. There's not a ton of crypto options, but those two are there as well. There are also the micro futures, which I talked about, which are 1/10 size of the standard regular models. Okay. And those will be, again, you have access to Bitcoin, crude oil, natural gas, many, many Forex currency pairs, and then all the micro futures, the Dow, the NASDAQ, the Russell, and the S&P. So that's a little bit about the platform itself. Now, the other thing I want to say is this does not operate anywhere in the gray area. It is owned and operated by Kraken at this point. It was bought out for $1.5 billion. Is a United States company based out of Chicago. You will have to KYC. You will have to submit your social security number. It is a worldwide company, but it does not cover everybody in the world, right? We've already found out it does not cover Ghana. I'm sorry, guys. It was not my intention to stiff anybody. We're trying to branch out. We're trying to bring some new tools and feature sets into our belt here. And I think this is really is a great option to give a shot to. Again, this does not make your edge better. It does not make your edge worse. It is a tool. Okay. If you have questions on this as you come across it, I do recommend using the desktop software, download it, install it, take a peek at it. It is not like TradingView. If TradingView is Windows, Ninjatrader is like Linux. Okay. It's got a ton of different options. It's a little cumbersome if you're used to just TradingView. It's a little cumbersome if you're used to just the simplicity of some of the crypto exchanges all kind of look the same. But at the end of the day, it's got its own F&Bs, its features and benefits. And the big one I really like is the fact that your entry model tool is there for you. And you don't have to hop through any hoops of connecting TradingView or anything like that if you don't want to. Although I'm going to give both a fair shake and see how they land. I'm going to add all the minis and the micros to my chart. And if you want me to share that file, I can certainly share that with you. But at the end of the day here, I'm excited. Ben's excited. We jumped through a lot of interviews to get this done. It's a professional platform. It's futures, baby. It's not, something you should be day trading on it, right? You want to make sure that you are in and out before the market hours are over, after they open, after they close. If you're not reading what it costs or anything like that for margin to hold overnight. Okay. So make sure you do a little bit of research before you just hop in and open some contracts up. But that's really the spiel, guys. Some things I did want to cover, just note wise. If you want to just use Ninjatrader for your data on TradingView, you can purchase that for just $16 a month for the level 2. And like plug it right into TradingView.
Interject there. There's zero chance you're going to be able to plug in order flow data into TradingView. You can
use it on NinjaTrader.
Yeah, right. You can get the live.
I meant that the other way around. You can use it on NinjaTrader and plug in your account you're trading on in the NinjaTrader. I said that half backwards. So if you're trading on E-Trade and you want to execute on E-Trade through Webull on just buying stocks, and you want the order flow data from...
You're messing up your words. So you can...
What am I messing up now?
You can plug in E-Trade or Webull or whatever your broker is into Ninjatrader.
Did I say TradingView? My fault. I'm not sure how many people are actually going to take advantage of that, but I think we're moving that way for the people who want to trade, on NinjaTrader, but with a separate account, would be the recommendation. Unless you picked it up on Webull or something like that, and you're trading like exclusively over there on your spot stocks. Other questions, comments, concerns? Let me see here what else is in my notes.
I believe you can also trade them on Kraken.
Yeah, there's a ton of platforms you can just straight plug into NinjaTrader. It's just like TradingView, right? So it's a execution platform. You can plug any of your accounts in there and then move on from there.
Why would I plug, like, say, my E-Trade into NinjaTrader? Or, I mean, why wouldn't you just do it on E-Trade?
Well, if you wanted one platform to execute on, that's why you would. Otherwise,
you gotta open and juggle tools. So like when the main menu comes up on NinjaTrader, there's a connect account feature, right? And then you can just flop through whatever. Like say you got 6 accounts. Say you got a Coinbase account, you got a Binance account, you got the E-Trade account, the Webull account. Your money's kind of spread everywhere. You haven't consolidated much. You can just flip a button to change where you trade all in one platform without having to manage 6 tabs open.
at the end of the day, John, it's a futures platform. I can't trade futures on my E-Trade account, right? So
correct.
It's a futures it's futures trading first. But if you want,
okay, so basically you can use it. You can use it as a dashboard then, basically for all your stuff, right? It'll be local for your futures, but you can do your spot stuff.
Yep, and you can
Kinda
also
using it
do
as
demo on it. So we talk a lot about demo. It's fun to use it on TradingView. It's fun to use it on every other thing. It's has a replay tool that's a little bit different. You can just replay like the New York sessions with live data. You can. I want to hammer home the fact that you need to trade futures and stocks and all of those things outside the crypto world that don't have free APIs to on-chain data. You have to have data loaded, right? So when you pull up a new ticker, you say, hey, I want this ticker plus 15 days of data or 30 days of data. And it'll just, boom, it'll load that all up for you right on the platform. So that is the big thing you need. And you get it free when you have an equity account of $100 or plus.
and just to put that in perspective, if you're using Addis, it's $100 a month. And then you need to buy data from DX Feed. That's $76 a month. You're looking at a $200 a month savings. Well, minus 16. Well, it's free, right? If you have $100 in the account.
It's free if you have $100 in the account.
Huge. That's a $200 a month savings to get free level 2 data for futures. So you can see real volume on the NASDAQ, on S&P 500, on gold, on silver. It's invaluable. It's not real data on TradingView.
And when he says invaluable, you can't do it without it, right? Otherwise, you're stabbing in the dark, or the price, like you'll hit fill, and it'll be just a random fill somewhere. It may be up and it may be down.
Anyone else?
Okay, so for $100 you get.
And then it'll also deposit match $100. So if you put $100 in, you'll have $200 in equity.
And then there is leverage.
It's all automatically leveraged. So those are the things I need everybody to take their time and realize. You want to use there's regular, there's mini, and there's micro. So you want to focus on micro contracts. They're 1/100th of the regular cost of a regular stock. Minis are 1/10, and the regulars are full size.
I think we
0.01 Bitcoin.
Yes.
Yes. And the fees are the other big thing. We talked about this before, but on the free end, if you take a limit order, it's 36 cents a contract. Now, that may not look like a lot to the people who are trading a little bit of money, but for the folks who are plugging in $20,000, $30,000, $40,000 trades, $100,000 trades, that's going to be a 300 or 400% savings or 1,000% savings over what we're paying in fees on some of these other exchanges.
What would that fee be relative to Bitcoin? Like when you say contracts, like is that a full Bitcoin or like?
To put it in perspective, dude, like pennies compared to what you're paying now.
Okay. Okay.
Yeah. And I'm talking outside of like if you're taking entries on BTCC, you're paying like 0.06 fees. This would be like paying 0.0001 fees.
That's
You could
awesome.
open a 100. You could open a $76,000 Bitcoin position for 39 cents.
My gosh.
Yep.
And then you can buy those down if you want to. There's like for $99 a month, you can cut those fees in half. But it has to be worth you trading more frequently to do those types of things. But it's free to sign up. It's free to try it. It's free to do the demo. The other thing I'm kind of excited about is every week they do a demo competition with live funds, or excuse me, with live like payouts, right? So you're not risking anything. You're trading on demo, but you can win some real money. So if you're looking to sharpen your edge and continue to trade with potential for making something out of it and not just the demo funds, rank yourself up in these competitions and bring home some money. I was pleasantly surprised to see Rob was in like the top 200. We have people in the wrong room. I'm going to pull them up. There we go. We got people in the right room. Is Rob in here? I don't see him, but he was like 211th last time I watched in the Trading View competition. There was 50,000 people registered. So we're cutting some iron around here with you guys, which is great. We see a lot of you guys making the progress you need to make. We still see some of you guys making the same mistakes you make over and over again. But like we're to a point now where you don't have to. We all know the Korean exchanges and stuff like that have that little bit of that gray area, right? And everybody panics when their money's on exchanges, and when things go down, right? When they go down fast and exchanges crash and stop losses get run through, these assets we can trade on these futures accounts aren't going to have those kinds of issues. Stop losses aren't going to get run, incredibly hard. The liquidity is there to close the positions. It's not just going to flow through things. But I'm stoked. I heard a lot of dinging in the chat. If you just give me 1 second, I'll look at that.
I think I answered.
You need to be 18 and over. I'm sorry, Parker.
Just steal your dad's
actually,
identity.
that's a good question. I don't even
Parker,
know the
steal
answer
your
to that.
dad's identity.
Just have your mom open one if your dad opens one.
That's what I would do, Parker. Brian doesn't know how to use the push talk button. Otherwise, he'd be yelling at me right now.
What is he trying to do? Oh, I see it now. Never
Just telling them you can fund it. Yeah, but I think this levels up the professionalism. I think this is going to attract what we want to attract. Like the issue with, we've been doing this 5 years, right? The issue with crypto is everybody just kind of disappears when crypto disappears, right? Bitcoin's sitting at about 60, 70K. All coins are in the shitter. We don't want to wait to keep you guys interested in trading, until the next bull run, right? We want access to things that go up and down markets, and to continue to short other things that go down in a down market. You have to be 18 years or older.
Cool.
With ID.
Let's park it. Let's move on.
Sure.
If anyone has any questions, reach out. We'll continue to talk about it.
Yep. It does provide BTC.
I think Incognito, you had a question on sessions, right? If I'm not mistaken. You can type in chat or type in voice. I think it was you. I don't remember where it was in Discord, but you asked a question like, we talk a lot about New York session, right? But what if you can't trade New York? How do you trade the other sessions like Asia or London, for example? So I briefly want to touch on that. And, so first off, why do we focus on New York session? It's, look at any chart. It's where the moves happen, right? It's where the liquidity is. It doesn't mean things don't happen during during London or Asia session. But more often than not, the real volume, the real liquidity, the real moves, the real volatility we need as traders to make money happens during New York. But that is not feasible for some people. So for futures traders who trade NQ or ES or gold or silver or oil or whatever, Bitcoin, that ticks when New York stock market's not open. You have the opportunity to trade during other hours, right? During the Asia session, during the London session. But I think if you treat all of those time frames the same way, you're going to have a very poor time in the market. A market, whatever the market is that you're trading, is not uniform, right? Each session has its own personality, its own liquidity profile, its own volatility, its own participation structure. I think if you are trying to learn your edge right now or find your edge in the market, figure out your entry model, your strategy, and build contacts and all that fun stuff that we talked about a lot, I really think you need to focus on the session that you can trade and not try to bounce around to different sessions. So I think if a trader, this is again for newer traders trying to find their edge. I think if you jump between sessions, you are essentially changing your game every trade, right? It'd be like practicing baseball one day, hockey the next, and tennis the next, and wondering why improvement is slow, right? When you trade the same time window, you're studying the same behavioral pattern repeatedly over and over and over again. And when you do that, your brain learns pattern recognition faster, right? And when we talk about like edge in trading, it's largely pattern recognition. That at the end of the day, that's what we do is, well, I've noticed this is happening, so let me bank on this happening again here for this trade, just kind of generally speaking. But in order to get to a pattern recognition level, you need repetition in a consistent environment. When someone trades the same session daily, they begin noticing things. When liquidity grabs happen most often, how volatility expands through that session, when fake moves occur versus real expansion, or when volume comes in or when it dies. And then, after 50 or 100 repetitions in the same environment, that's where the patterns start to become obvious. And without that consistency, then every trade's just going to be like a new puzzle with different rules. And the most important part for beginning traders is data, right? So when you do this, your data becomes statistically meaningful because it's consistent data, right? If you're building a system or trying to figure out these markets and your data is inconsistent, then the feedback that the data is going to give you is going to be inconsistent. Like, okay, well, this is working here, but then I lost some trades here. It just gets convoluted, right? So for example, here's an example of bad data collection. You trade Asia Monday, you trade New York Tuesday, you trade London Wednesday, and you trade randomly in an afternoon on a Thursday. Then you analyze 20 trades. Those trades happen in completely different environments. That's mixing different data, right? It's like you're mixing different weather patterns from different parts of the world. Rain data, snow data, desert climate data. Does that make sense? And I think, Eddie, you're going to agree with that. I mean, you trade Asia a lot, right? And you mentioned before, you've been noticing some patterns, right?
Yeah. I mean, trade a session enough, you start to see, easy plays. Like New York's known for sweeps. We catch those a lot. Asia is more about a trend. You watch VWAP, that 15-minute session VWAP. You look for that break with intention and that back test, and you look for the trend continuation. That back test has been really nice to me.
And then, where does confidence come from, right? Confidence in the markets. I'm not talking about overconfidence, but like where you start to trust your strategy or your edge. It doesn't come from winning trades, right? I've been confident off of winning trades. So you know what the market usually does to me when I'm confident off of winning trades? It usually smacks me in the ass, right? And humbles me. Confidence comes from familiarity with a specific environment. When someone watches the same session for months, they start to see things and feel things, right? Like this move looks weak. This breakout looks real. Liquidity is probably sitting here, or whatever that kind of intuition that you're building is. So, Eddie, can you make money during Asia session?
Absolutely.
Can you make money during London?
Yeah,
for sure. Now, how do you learn, right? So I'm going to make this super, super simple. backtest, backtest, backtest. Throw on the TradingView trading sessions indicator. It's literally just called trading sessions. It's free. It has all the different sessions. Find the time frame that you were able to trade based off of your life, your schedule, your availability. If it's Asia, it's Asia. If it's New York, it's New York. If it's London, it's London. And backtest them. Now, I can tell you, if you are trading Asia and you are holding on for the moon, you're going to be awfully disappointed. You're going to be. That doesn't mean Asia doesn't sometimes get big moves. But more often than not, it's more like this. It's more like this. More like this. More like this. More like this than it is like New York. Right? So what works better in the Asia session? Is it trend continuation strategies? Is it breakout strategies? Is it mean reversion strategies? Well, I think that probably depends a little bit on the type of environment we're in the day, but I would say it's more probably mean reversion trading than it is breakout trading. That doesn't mean breakouts don't happen, but more often than not, you can literally just put on this indicator and start forming your hypothesis of what kind of trader should I be in the session I'm in. Mean reversion, what does that mean? Away from VWAP, short that shit back to VWAP. Below VWAP, long that shit back to VWAP. Not that sometimes in certain environments we don't break though. You don't want to hold for the moon during Asia. Why, Eddie?
Because New York's coming to take it
New
back.
York's coming to take your stop losses.
Maybe even London.
Maybe even London, 100%. The best, if you want to know what the best two time frames or the best two times to trade in the markets are, it is right here on my screen. And it's like the overlap between London and Asia, right? So like London open basically. Because why? Because you have two sessions firing, two parts of the world firing each time. So the Asia to London overlap and the London to New York overlap. Those usually produce the biggest moves across all futures contracts, all equities, all whatever, Bitcoin. Other than that, just again, pick one that fits your life, fits your style, pay attention, recognize patterns, don't deviate, don't hold for the moon if it's outside of New York or outside of one of those two big heavy volume areas. Any questions? Anyone have any input? Any experience trading? I don't trade Asia or London, so I don't have a lot of experience, but I understand how they work. Now, what if you're a swing trader? Does session matter?
Yeah, Ben. I have a question on this topic. Because for those focus on high time frame entries, won't the contest be the contests often be different if the level is more important than the time? No, shouldn't we be entering regardless of the environment? Following that logic, it seems like swing trades will always be riskier than because they have to push through different market environments. No.
So I think if you're going to be a swing trader, which means you are watching higher time frame levels, you're not watching intraday stuff. You're not zoomed into a 5 or a 15-minute chart, right? You're watching 4-hour, daily, weekly levels. I think the session context matters less, but it's not like it doesn't matter at all. So just as an example here, let's look at this current week high here on NQ. It didn't matter during New York. Why? Because Asia came and took New York stops. So you have to be prepared for that to happen. So if, for example, Asia, or let's say your swing level gets taken on during New York session, and then Asia dies, there's a good chance, it's not zero, that New York comes to take losses and then continue the trend. Does that make sense?
Yeah.
So if you risk properly, if you plan or anticipate the New York stop rate, if you take a position during Asia or during London off of a swing trade, you just have to know that could happen. So does that mean if you take a trade off of a macro swing level during Asia or during London, you put your stop out of harm's way? So maybe that means that your position size isn't as big, because position size isn't based on stop. Well, I mean, it is, right? But you would be using less margin to have a wider stop. Does that make sense?
Got to give it that breathing room.
Yeah, you give it a little bit more breathing room, man.
Yeah. Need to adjust position size, right? And stop too, of course.
And again, here's my favorite word in all of trading. Trading is probabilistic. Sometimes it's just gonna do whatever. Like if you're looking for a breakout during Asia, sometimes it's just gonna break out during Asia, and then New York will then kind of pull it back, not sweep Asia, and go. Sometimes it won't do that, and it'll do something else. But that's where risk management comes into play. Put your stops where your invalidation is, where you're wrong. But if you're trading off hours on a macro swing play, maybe your stop's a little bit wider, and then you position size to meet that stop. It doesn't mean instead of risking 1%, you risk 5%. You still plan the trade properly.
Okay.
Maybe you take a little hit on the risk to reward, but that's okay.
To answer your question in the chat, why do sweeps happen in New York? I'll go into a little bit, but I'm sure Ben's probably going to have a lot more insight on it. But essentially, it's just liquidity, man. It's a bigger market, a lot more bigger players. They're not going to enter. They need to get a good fill. So a lot of times you're going to get the sweeps of those lows because that's where the liquidity lies, or the break of the high, the SFPs. That's where the liquidity's at.
Yeah, and I mean, sweeps happen in all sessions. I know they just happen more in New York because that's when more volume comes in. Thus, more liquidity needs to be injected into the market. Why do sweeps happen in the first place? Someone want to take a stab at that? I think that's where you start. Like, why? Why do stop raids happen?
Fill larger orders.
Fill larger orders. And there's a lot more larger orders during New York than there are during London or during Asia sessions. So people need to be filled. So that's why you see it more often. New York loves to raid London stops, loves to raid Asia stops. It loves to take those people out of the market so they can enter, so they can fill size. If I'm, whatever, if I'm a big whale in the market and I need to get in where there's liquidity so I get filled properly. And where can I create liquidity? When stop losses are taken. So anyone who went long down here puts their stop losses down below. And this is just an example. So New York will push it down, create all that liquidity so they can fill their orders, because for every buy, there's got to be a sell, and then go up. And then it just happens more in New York because there's more volume. And then what should I do? I want to know what I should be even looking for. Well, that's what you're looking for. Behavior. You should be watching price, marking out your levels. Hopefully you're on all the courses, because I explain liquidity. We're getting into explaining what levels to watch. That's actually the videos that I'm working on right now. I hope to have that out tomorrow. I think that'll help you a little bit. But just where does liquidity live? Above the highs, right? Sessions, weekly levels, daily levels. Mark out your battlefield and just watch how price reacts at those levels. Watch how your session behaves. Like I mentioned, if you're trading Asia, it's more probable that it's just a reversion. It's just gonna kind of coil around VWAP, right, Eddie? I mean, you can look at this. You can look at it. Look at it on any chart. It's just like here's a sweep during Asia, swept New York, back to VWAP. But it wasn't like it swept New York and then blasted off to the moon. But there was a nice little scalp there. Nice little, this is on the NQ, you know, nice little 0.4%, 0.5% scalp. Anyone got any questions? By all means, like, don't be afraid to ask what you think are dumb questions, because they're not dumb questions, because I guarantee you 10 other people have the same questions. All right. Now, I want to talk a little bit about the harder part of trading, because that shit's easy. Marking out the battlefield, watching sessions, picking your entry model. I mean, really, at the end of the day, you got 3 entry models to pick from: sweep, bounce, break. The strategy is the more harder part. The part about building context for the day. This isn't going to be a long thing about context, because we're just going to keep building on it. I don't want to bore everybody. But I think if you are struggling with building context right now, these are I think this is 11 tickers. 1, 2, 3, 4, maybe 12, because there's 2 yields on here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 13. I think everyone should screenshot this, add this at the very top of their screen on macro, or I'm sorry, on TradingView. Label it macro, and this is where you're going to start your context building strategy. Now remember, your strategy in your entry model, or I should say your entry model, does not live in a vacuum. It lives inside of risk on or risk off environment. And starting, I don't want to throw 50 different things at you, but starting, you should start to learn what these tickers are, right? So why the futures tickers for the NASDAQ and the ES and gold and oil? Because they tick most hours of the day. It's not just closed like the NASDAQ closes during New York session. You get to see what Asia's doing, what London's doing, map out the liquidity. So NQ1 exclamation point, ES, that's just NASDAQ and ES. You don't need IBIT on there. That's just for me. That's, Bitcoin on the stock market. That's just BlackRock's Bitcoin ETF. You don't need that one. So let's kind of break these down a little bit. Anyone know what RTY1 is?
Russell?
Yeah. Why is the Russell important to watch, John?
Say again?
Why would someone watch the Russell?
Those are the smaller, right? Those are the smaller companies. They're the ones that are most sensitive to the interest rate changes, right? And that's actually where it tends to rotate out of, right, into the Russell, right? When the Qs go down and S&P starts, a lot of times they rotate. I mean, that's the reason I watch it, right? I mean, it's if we get into a interest rate going down market, then the Russell likes to run.
Yeah, I mean, it can tell us risk appetite. At the end of the day, that's what it's telling us. Like, it can tell us, are people risking on or people risking off, right? At the end of the day, I mean, that's what it is. That's what ES and NQ is too. The Russell is just like a more... I
mean, the NQ, right? Those are more like your growth stocks, right? Yeah, these are like your... It's I know it is. It's the shitcoin market for stocks, right?
Yeah, at the end of the day. At the end of the day, it's 2,000 kind of mid to the lower cap compared to, the NQ and the ES stocks. Some of it does overlap, right?
But yeah, it's the altcoin market for stocks.
Yeah, at the end of the day, it is. So, John, if NQ and ES are dumping and the Russell or RTY1 is pumping, what does that tell you? What could it tell you?
Well, yeah. Well, to me, it's just a rotation, but yeah, it's that, I don't know. That's usually looking to see that the market's shifting attitudes, right? I mean, we saw that, right? The last 3 months that the NQ were down, right? It was moving over to the Russell, right? We saw that at the end of the year, right? As people were thinking that interest rates were people were looking at interest rates going down, right? And that's when that's all the Russell people need loans, right? Because they're all low liquidity. That's the only reason I know of it. I'm guessing I missed what you're saying, but
It also can tell us that a top is near, because when the highest risk things start to move, that's usually like near the top, the euphoria phase. And if you like follow the stock market cheat sheet.
yeah, that's true. Yeah, because if that means the NQ, it's like it used to be with Bitcoin, right? Once Bitcoin kind of tops out, then it would go into the altcoin market. Same thing, right? Yeah.
I think it's also important to understand. Was someone else going to talk there? I think it's also important that when you're context building, or you know, the name that like desk managers will use at like hedge funds is regime, right? What regime are we in right now? It's not enough to just say like risk on, risk off equals bullish or bearish or long or shorts. I think that's way too simple. So like rotation, like John was talking about, right? So the NASDAQ is tech, it's tech heavy. NVIDIA, you know, Microsoft, you know, it's a very tech heavy index. It's a growth thing. The ES is just mega caps, and it's like a broader market, right? It's 500 versus 100 stocks in the NASDAQ, where the NASDAQ is more tech heavy. And the Russell is just small caps, and it's risk on speculation. That's what the Russell is for. Risk on or risk off. Now it's a rotational thing, like John mentioned. It's not necessarily like a bullish or bearish thing. So if the Russell is running and NQ and ES are down, it can mean a few things. And it all depends on what everything else is saying at the end of the day. But it could just mean capital rotation out of mega caps. Is that kind of what we saw, John, over the last 6 months or a few months?
We did.
Yeah.
Yeah, and then also then all of a sudden the Dow, everybody was like, "Oh, Dow is such a turd," right? All of a sudden the Dow fucking took off, right? You know, the big old companies, right? Same thing. I wish that one caught me off guard, right? I was like, didn't realize the whole sector rotation thing is new to me, right? It's not something I was paying attention to until the last 2 months, mostly because I watched myself miss it.
So when people get into riskier things, which, I mean, again, we're equating this to kind of like the altcoin market. And even that, I think, is an oversimplification comparing the Russell to altcoins, but I get the sentiment. People are chasing higher risk small caps. That could be seen as a good thing or a bad thing. Maybe it's a top signal, like Eddie said. That's what you said, right, Eddie?
Yeah, like in the macro, it can be a top signal.
Maybe it is. Maybe it could be short-term risk on, period. Like it's a short-term risk on rotation. People are taking money out of mega caps, right? They're taking money out of NVIDIA and Microsoft and all these big, giant, trillion-dollar, you know, companies, and they're putting it into the littler guys. You know, they're willing to hold higher risk. So it could be a sign of shorter-term risk on in the markets. But it's not automatically like bullish for the entire market. It's just internal rotation. I think true bullish might look a little bit different. I think when the market is actually strong, if you're looking at the NQ, the ES, and the Russell, what do you want to see? What would just looking at those three things, if that's all we could look at, what would you want to see out of all three of those things?
Well, if you want bullish, right, you want to see the NQ usually running, right? And S&P usually tends to follow a bit after, right? I mean, that's euphoria more, right? If the Qs are shooting up, then you know that's the bull, and that's more bull markety, right?
Yes. Yep. Hunter, you nailed it. You want broad participation, right? You want everything. NQ up, ES up, RT, the Russell up. That means liquidity is lifting the whole market. Right, and if only one index is green, like the RTY, for example, that just means the overall market might be weak. People are like trying to squeeze out some pennies out of the Russell. It could mean that. Breadth.
Yeah, I mean, from what I saw, right, from what I've seen and kind of stuff I've listened to, yeah, it's like rotation it's capital shifting in the market, right? But but if Q is going up and the S&P is going up, and then Russell doesn't usually go as hard, but if at least it's moving, that means new money is coming into the market, right? Right. It's not rotating. It's you're getting more capital in the market, right? So that's why everything can go up, right? If the big guys are going down and Russells are going up, then that just means money's shifting. It's not really, doesn't really mean new money, right?
And Nick, let's pause. Why is Ben and John, and why are we talking about context and risk on and risk off and trying to build that narrative, that strategy? Like, why? As traders,
It's going to be just based on the way you're going to trade. They're going to formulate a whole plan.
So if you're in a risk off, I mean, Brian, if you're in a risk off market, you answered this question today, so hopefully it's on the tip of your tongue. What might a trader do?
Take quick profits.
Yeah.
There you go.
Take quick profits.
Smaller position
man.
sizes.
Maybe smaller position sizes, right? Because why? Because that's what people do in risk off markets. That you're not breaking out, right? And we've been in a risk off market now for 6 months, ladies and gentlemen, where the NASDAQ, the ES has been chopping sideways for 6 months. People are not holding, right? They're in trade shorter time period. Thus, we should be in trades shorter time periods because things aren't running. It's you get in, you take your profits, you protect your downside, and you get out. Versus a trending market or a risk on market. What happens in a risk on market? People hold longer.
Yeah. Even still, you can, even in the spot world, which is learned kind of the hard way, was, okay, so you don't want to get out. Like I said, it's running. You can still just set, stop losses, right? Limit, where you could be like, okay, well, if it retraces, sell off, whatever, 10% or whatever, right? And preserve capital. Maybe you don't want to, you feel like it, still got more room, but you can still just say sell, sell 10%, sell 20%, whatever you feel like, right? If you want to buy and hold some long term, but you want to retain profits, damn stop losses, even in just spot trading, right?
Yeah, a lot of time the Russell climbs first. Like when you start seeing risk on behavior return to the market, a lot of times Russell goes first. And then ES stabilizes, and then NQ follows. But I think the moral here, what I personally watch, NQ up, ES up, RTY up, strong market, right? If one index is up and the others are flat or down, that's mixed, right? It's a mixed / rotational market. And then obviously what's a weak market? All three are down at the end of the day. That's what you're looking for. And I think the key concept here is what they call market breadth. What you're really asking is a question about breadth confirmation. If all the major indexes disagree, it means liquidity is not aligned, moves are less reliable. Take profits quicker, which fits a core trading rule. The best moves happen when multiple markets confirm each other. And then oil, gold, the dollar. Boy, are those important right now. Those are.
Yeah, what I would say is you might want to throw like TLT in there, right? Meaning if you see, if the bond markets, if TLT is spiking, right? I mean, that's sort of like watching like a I would say it's like USDT dominance in the crypto world, right? If you see the bond market, you see a lot of money going into the bonds, right? That means people are really going risk off.
Yeah. So I'm going to make oil super simple for you guys. We got a little bit of time left here. Oil skyrocketing, good or bad? Overall for the global economy.
It's bad.
Bad.
Why?
Everything costs more. Transportation.
Yeah.
That means everything's going up in price.
Inflation. It's inflationary, right? At least temporary. At least while it's running up. Yeah.
How about gold skyrocketing, good or bad?
Bad.
Why?
Because everybody's running from the dollar and running to the safest asset.
No, I would say gold running I mean, at least we've seen here, right? It tends to be because usually gold's going up. It's in relation. It means the dollar's going down, which usually is also inflationary for assets, right?
Yeah, I think
Usually it
gold's.
tends-
Yeah, I think both answers are right, but I think there's nuances in there, right? So I agree. When the dollar goes down, I mean, everything kind of goes up, right? And that's what we've been seeing lately is the dollar, well, not since last Friday with the war, but the dollar's been dropping and NQ and ES have been sideways. You know, there's a lot of people thinking, and I'm in this pool where, you know, if the dollar wasn't dumping like it was, if it was going the other direction, then the NQ and the ES would look more like a Bitcoin chart. Maybe not as extreme, but they'd be not chopping sideways for 6 months. So
I mean, I just got dinged, like all the metals, like dollar, you know, because of with the war, right? People dumped into the dollar and the dollar spiked, right? And that's where we saw all of our metals and shit go down, right? Yesterday. Right?
Yep. So when the dollar, sorry, you might have just said this, and my brain needs to say it out loud again to make sure I'm understanding what you're saying. But for the last couple of days, the dollar's been ripping, right?
Yep, and it took our right, and you watched gold and silver, copper, platinum, all those guys went down.
Yep,
right?
100%. So cool. That's you know, in a nutshell, kind of what you're looking for to build a thesis, and then you kind of stack them all together, and you start to form a narrative, right? So dollar down, good for us. Dollar up, bad for us, generally speaking. How about the VIX? Anybody know what the VIX is?
Volatility index.
Yeah, anyone know why that's important?
What does that actually measure, the VIX?
It's if it's down, right? When the VIX is down, usually that's good for us, right? Right. But if the VIX hits, you know, if it's peaking, right? Usually that's, well, like the VIX, like, but it was like last April when everything was crashing, the VIX was like up at fucking 80 or whatever, right? I mean, super high. So, but then if you do see the VIX peaking somewhere or at a level, right, that's also where you can see where there's a potential turnaround in the market, right?
Yep. And Beth, to answer your question directly, the VIX is the S&P 500 volatility index. Does anybody know what happens when you take the number that the index is at? So when I took this screenshot a little bit ago, it was 21.14. Does anyone know what you divide it by? Anyone? What happens when you divide it by 16? No one knows this?
No clue.
You get what the the S&P 500 should do for that day. The amount of movement, the rule of 16 on the VIX.
Really?
Yep.
So only 1.3%.
Wait a minute. So, like, and it's like up or down?
Yes.
That's the window, like up, let's say whatever. So if it's 1.3, it'll be like, it could either be 1.3 up or 1.3 down.
Yep. And that's not obviously binary. It's not black and white, but it's actually pretty damn close, dude. It's pretty damn close. Just how the VIX is calculated. So like John said, VIX up, bad. VIX down, good. And then 10-year yield's a big one, right? What happens when yields go up? What are people doing? Generally speaking, typically speaking, I should say.
Risk off.
So when
yields are going up, usually means that they're okay. Make sure I got this. It's like inverse, right? So if yields are going down, that means more people are going in, right? So they don't have to offer as much, right? But if people are going out of the bonds, they have to raise the yields, right, to try to get people to buy the bonds. Am I correct there?
Yeah, generally speaking, you are correct. So ZN1 exclamation point is what Donkey was talking about. That's what you can trade on futures. That is the actual certificate itself, right? So that's the actual tradable asset. But that tradable asset produces a yield, right? So that's a US 10Y. So it's the yield versus the actual asset. And they're an inverse of each other, and their charts look exactly the same, just in the other direction. So when Was someone talking?
Oh yeah, I was just going to say. So an easy way to TLT is the 10-year bond ETF, and so yeah, you can just chart that too, right? And basically, like you can watch, like for the last 5 years, it's just been going down the toilet, right? But basically, yeah, the TLT is another way to just track the 10-year.
So, and we have two more to get through, and then I'm going to quickly run through and paint you guys a picture of what the markets look like right now and have everyone just mentally make their own judgment, and that'll be the lesson for tonight. But so 10-year yield going up means people are selling the treasuries. 10-year yield going down means people are buying the treasuries. Now, whether that's good or bad, I think depends on everything else. And I will explain that in the example portion here. Now, XLF and XLE, John, what are those two? The last two?
Finance and energy.
Finance and energy sectors. Why is it important to watch finance sectors?
Finance, I think, is the second biggest, right, of the market, right, after tech, right? And but that's so finance tends to be a risk on, they seem to, but then energy is kind of the one of the hedge markets, right? Where a lot of people like shift out into energy.
Yeah, what happens if XLF is just like continually dumping? What should you be worried about?
I mean, it's liquidity, man. Banks going bankrupt, right?
Yep. That's the opposite of what you want to see. I mean, that's the opposite of what we want to see, as traders. We want XLF to be healthy, going up. And XLE is it's the energy sector at the end of the day. Do you want that up or down, John?
Well, if you're in it, you want it to go up. But on the other hand, it reflects people's pay, right? How much they have to pay, right? So if they have to pay a lot for their energy, they can't buy shit, right? So